Today we're going to be going over the entire home buying process. We're going to start at ground zero with the pre-approval process, and we're going to be ending where you get the keys and we're popping champagne. This is not going to be a 2-hour video, so we're not going to get super granular on everything here. So if you have any questions, you want us to go any deeper with you, please just reach out to us. We love talking about real estate, especially with first-time home buyers. So please set something up with us. We'd absolutely love that. All right, so we're getting started. Step number one is to get pre-approved. The reason why this is so important is because you really need to know what your budget is before you go out shopping. It's a tremendous waste of time if you're looking for a while in the wrong price point and it turns out that it's just outside of your financial reach. You really want to start and get pre-approved for your loan right at the beginning here. So what goes into that? You're going to get connected with a lender or mortgage broker, and they're going to ask you for a certain amount of documents. They're going to want to see some tax returns. They're going to run your credit. They'll look at some bank statements, and they'll look at your debt to income ratio, all this stuff, and then they're going to give you a max pre-approval, meaning they're going to say the highest loan amount, and then that will translate into the highest purchase amount that you qualify for. And then you're going to have to see, based on what that monthly payment looks like, if you're comfortable spending that much. Some clients that we work with, they're absolutely okay to max out their pre-approval amount, and other clients that we work with, they say, look, I appreciate that you're willing to give me a loan for this amount, but I don't want to spend that amount on a monthly basis. I'd rather spend this lower amount, so let's recalibrate the budget based on this monthly figure here. So it's really important that you work with your lender. Again, you're going to start with a max pre-approval, and then you're going to lower to what the actual budget is if you're going to be lowering it. So let's talk about some different loan products here. There's a 30-year fixed mortgage. That's probably the most common product, and that means that your interest rate is going to be locked in place, not going anywhere for 30 years. That's great, especially if you're going to be wanting to maybe keep the property as a rental after you graduate from this. Great to be locking in a lower interest rate for a longer period of time. There's also adjustable rate mortgages. These are also called ARMs, and for example, maybe like a 5-year adjustable rate mortgage, that's something where for 5 years your interest rate is locked, and your interest rate is going to be a little lower than that 30-year fixed interest rate because it's for a shorter amount of time, but then it's going to reset if you still have that loan to more current interest rates at that 5-year period, again using the context of a 5-year adjustable rate mortgage. Now, where a lot of people get it wrong is they think that they need to save 20% for the down payment. If you have 20% for the down payment, that's great, but if you have less than that, you can still purchase real estate. And it is so much better to get in the game sooner rather than later, putting a lower down payment rather than waiting on the sidelines, throwing your rent money away, and just watching prices continue to rise to save that 20% down payment. Get in the game sooner than later. We see 0% down for a VA loan. That's for veterans. If you're not a veteran, you can put as little as 3%, 3.5%, 5%, 10%. These are all very normal down payment figures. And the reason why people have 20% in their head as a figure is because if you pay less than that, with the exception of a few niche loan products, you're going to pay something called mortgage insurance, also called PMI, and that's an added cost for having less than what the bank really prefers is that 20% down payment figure, just because they're leveraged a little bit more. So that's maybe $100, $200 a month, something like that. Again, it's an added cost on top of your mortgage, but much better to pay that and then ride appreciation. And you can also refinance out of it down the road. You're not stuck with it for the life of the loan. So if you come into more money and you want to pay more towards your down payment, great, you can refinance out of that mortgage insurance. Also, if the home just appreciates a lot and you have all this equity in the home, you can do the same thing. So get in sooner rather than later. The other big thing I want to make sure people understand is that you don't have to do this on your own. It's so normal for family members to help with down payment funds. Southern California home prices are very high. As a first-time home buyer, like I said, it is very hard to have 20% saved up. So parents can help with down payment funds. Parents can also help with something called co-signing. With co-signing, they're actually going to be on the loan with you, where their income is going to be calculated just with your income. So if you wanted to qualify for a higher monthly payment but couldn't do it on your own, That's where a family member co-signing can really come into play. Okay, now that you're pre-approved and you have a budget in place, it's time to really think about what type of property is going to make sense here. Because buying real estate, there's all different types. The most common that you're probably thinking of is a single family home, and that is just a fantastic investment. You know, you have your house, you have your yard, you're buying all that. Sometimes you can't afford that though, especially as a first-time home buyer. There are condos and townhouses. Those are great options. Some people get a little caught up on, oh, I don't want to pay money on the HOA that's not going towards the principal. But that is a little tricky because if you think about what that HOA money is going towards, if you're a single family homeowner, you're probably just paying that on your own. It's just not called HOA. So we're talking about your gardener. We're talking about your pool maintenance. There's gyms sometimes that are part of the HOA. You don't need a gym membership if you are in an HOA that has a gym. Let's see, if you're a single family home owner, you're going to need to just have some reserves set aside in case some of the major systems of your property need to be worked on. We're talking about roof. New roofs are $15,000, $20,000. Sewer line, if you need to repair your whole sewer line, that can be $25,000 or so. Foundation, that can really get high, but I've seen foundation quotes north of $50,000. If you're in a condo, that's all part of the HOA, so the reserves are going to be going to that. So I just want to make sure that we're not discriminating against condos, because a lot of first-time homebuyers that I talk to, they say, I don't want to buy a condo, I'm just going to wait until I can afford that single-family home. And like I was saying earlier, the game with real estate is get in as soon as you can. If all you can afford right now is a condo, get in, and owning that condo, riding that appreciation is going to help you get that single-family home a whole lot sooner. Let's talk about some other property types. 2 to 4 units. Those are really, really popular, and if you're a first-time home buyer, this is probably, just from an investment standpoint, the best way you can park your money. If it's a 2 to 4 unit, you can use loans for as little as 3.5% down if you're going to be owner occupying, where you can get in, you'll have your unit, and then you're going to have the rental income from all the other units. And by the way, when you get pre-approved, if you want 2 to 4 units, you need to make sure that your lender knows that, because your pre-approval amounts are going to go up with each unit count. So you'll have a single family amount, a duplex amount, triplex amount, quadplex amount. The reason why it goes up is because you're going to have more income from each unit. So that's why your budget goes up there. And that is just, again, a really, really great way to get started if you're looking to take on more of an investment route with your real estate. Another really cool property type, something called small lot subdivision homes. So in California, there was a law passed in the early 2000s that allowed property owners to subdivide their properties and put multiple single-family homes that are very close to each other. And you've probably seen these driving around. They look like townhomes. They're built very vertically, and there technically is 6 inches of air gap in between them. So different than a townhouse where you share walls with your neighbor, these you don't share any walls. They're very close together, but you don't share any walls. So you technically own your whole structure. And the benefit for these is that your money is just going into the actual structure, basically. You're not paying for this big yard or big lot. And so what that means is that for a much lower price per square foot, you're going to get oftentimes brand new construction. And if you are not at that stage in your life yet where you really need that big yard, it really makes a lot of sense. These units rent really well, and a lot of them have rooftop decks. So to me, that's the best of both worlds, because you still have a really cool, great space to hang out and entertain your guests, but again, you're not paying for that yard. So small lot subdivision homes is something that you might want to consider. Let's talk about TICs, tenants in common. This is a relatively new property type to Southern California. They've been around the Bay Area though for over 30 years, and they function very similarly to condos and townhouses, where you have your unit and then you're part of a greater HOA, but technically they're a little bit different. With these, you're actually purchasing a fractional ownership in the entire community. So if there's 4 units, maybe it's a 1/4 ownership interest, then with exclusive use and rights to your unit. And the financing is very different for these because it's called fractional lending. So because of that, because it's such a niche lending product, the prices are going to be a bit lower than if it were a condo or townhouse. So TICs is actually a really good kind of entry-level property type for that person who's renting that's not quite yet able to purchase a condo. A TIC is that perfect option to get out of renting and get into ownership. Another thing you're probably going to hear a lot about during your search are ADUs, or accessory dwelling units. California passed a law, I think it was around a decade ago, that allowed for garages to be legally converted, where you can add that square footage to your property legally, you get your own address, and you can also rent them out if you want. It can either be working within the existing garage structure, or you can build those units on your lot. There's all these zoning regulations, so you have to make sure your lot is big enough and whatnot, but it's a really, really great way to add value to your property, to capitalize on some rental income, and you're probably going to be looking at places that either already have them or the properties are being marketed as ADU potential. Okay, now that you're pre-approved and you also have a general understanding of the different types of property that you can purchase, it's time for you to connect with a real estate agent. The single most important trait that you should be looking for is local expertise. If they don't know the area that you want to purchase in, they're not the right real estate agents for you. They're not going to be able to tell you the difference between if you're south of this street, property values are up, if you're north, they're lower. They're also not going to have relationships with the listing agents, and those relationships play a huge role in getting your offer accepted in really competitive situations. You also want to make sure that they specialize in working with first-time homebuyers. If you're working with a realtor that has 80% of their clientele as investors, it's just not going to be the experience that you're looking for and that you need as a first-time homebuyer. You want to be working with somebody that goes out of their way to educate you, slow everything down with you, hold your hand, because you need to understand what's happening every step of the way. That's the only way that you're going to have the confidence that you need to win in this market. The other really, really, really important thing to keep in mind here is that you need to like this person. You're going to spend a lot of time with them, checking out properties. It's going to be really stressful talking about how much money you're bidding on the place. And then once your offer is accepted, you're going to spend money on inspections. Maybe inspections aren't going well. You have a big repair negotiation. We'll get into all that in the escrow section. But it's going to be stressful. And so you're going to be in the trenches with this person. And so you need to like them and you need to trust them, because it will get a little gnarly at times. And so you need to have that relationship with your realtor. Okay, so now that you've picked your realtor, we're going to start with the search here. And so they're going to be talking about the different neighborhoods, and maybe there's a new development coming into town that's going to increase values. You're going to lean on all their expertise to figure out exactly the property types you're looking for and the areas that you're going to be looking for them in. And so they're going to be sending you properties, and then you're also going to be sending them properties. You're going to be picking your favorites that you want to check out together, and then you're just going to start touring them. And you should not feel any pressure in the first few outings, especially zero pressure to be obligated to be writing offers. You need to be understanding the market. You need to just get out and you need to get inside homes, because that's the only way that you're going to build the context in your brain to understand if one is a good purchase compared to the next. So it's just going to take some time, and you need to be working with a real estate agent that has patience for that. You're eventually going to find a property that you're pretty darn excited about, and you're going to say, hey, let's go get this one. I want to write an offer. Your realtor, the first thing they're going to do is they're going to run what's called comparable sales, where they're going to be looking at similar sized homes in the neighborhood, similar condition, to figure out what market value of this property is. Because list price and market value are two very, very different things. In really hot markets, a very popular strategy is for sellers and listing agents to underprice the home, well under what market value actually is. So you're going to be bidding way over list price if the comps justify it. Now, sometimes sellers are overzealous, they get greedy, and they shoot for a really high price. That it makes no sense from a market value standpoint to go up here. So you're not going to write your offers anywhere near that. The only way you're going to be able to put together an intelligent offer strategy is if your realtor gives you a very good comparable sale analysis to dictate what market value is. The next thing your realtor is going to do is really dig in with the listing agent to try to get a sense of what the seller is looking for in an offer. Maybe they need a lease back. That's where after the sale closes, the seller is able to stay in the property as a tenant to the new buyer for a short period of time, which is very attractive for sellers because if they're also closing on the next property, it gives them time to move money around. They don't have to worry about moving twice in the interim. So there's all different things that sellers could be looking for, and you want to craft your offer to cater to their needs. Obviously, it needs to work for you as well, but especially in a really hot market, you're trying to win a beauty contest the majority of the time. You also need to figure out if there's an offer submission deadline. Is seller just looking at offers as they come, or are they for sure not going to respond until a certain calendar date? Is there a chance that they won't counter the offers? Is there a chance that they're just going to pick something on the first round? This obviously is going to play a big role in your offer strategy. And so your buyer's agent, again, it's very important. If they don't already have a good relationship with the listing agent, they need to build that rapport quickly, because you're going to send your offer in. More likely than not, you're going to get what's called a best and final counter offer that says purchase price to be best and final. And what the hell does that mean? You as the buyer, you need more context. So I believe that it is your buyer's agent's sole mission in this instance to get you as much context as possible, because you don't want to lose by $5,000, but you also don't want to win by $100,000. You really want to know what your competition looks like, and every listing agent plays that differently. They might keep that information closer to their chest, but still, it's your buyer's agent's job to do everything they can to get you context. How many offers were submitted? How many were over list price? How many were all cash? Did some remove a bunch of contingencies? What was the highest offer on the first round? These are all things that really help you dictate your best and final counter offer strategy. Okay, so your agent did a great job. You knew exactly what you needed to do to have a really good shot of winning. You submitted it, and then you prayed to the real estate gods, please, 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 please let the seller pick me. And then your buyer's agent calls you up, and this is my favorite part of all of real estate, calls you up and says, my guy, great news, offer is accepted, congratulations, get ready to open escrow. All right, your offer is accepted and we have just opened escrow. What the hell is escrow? Escrow is the process from accepted offer to the close of the transaction. We're at closing, that's where you're the new owner, you get the keys, all that lovely stuff. So the first thing that you're going to do after the offer is accepted is you're going to get wire instructions from the escrow company, which is going to be a third party in between you and the seller, to wire to the escrow company 3% of the purchase price, and that is called your earnest money deposit. And your earnest money deposit is what ensures that you as the buyer play by the rules of the contract, meaning that if you want to cancel the transaction and you expect to get that 3% deposit back, you need to use your contingencies properly. What are contingencies? Contingencies are your get out of jail free cards in an escrow. Your three biggest ones are the inspection contingency, the appraisal contingency, and the loan contingency. There are more than that, but those are the three ones, so for now we'll just focus on these three. Let's start with inspections. Again, one of the first things that you're going to focus on at the start of the escrow is lining up your property inspections. If it's a single family home, we recommend starting with a general home inspector, a sewer line inspector, and a termite inspector. The general inspector, they're going to look at just about everything in the property, and they're going to be able to tell you if more specialized inspections are needed. So maybe you need an electrician out, a roofer out, a mold inspection done, foundation. The list is really infinite. Maybe asbestos, maybe radon. You really don't want to spend all this money. You can spend, north of $5,000 on, 20 different inspections if you want. You really don't want to do that unless you need to, so that's why it makes a lot of sense to start with those three and then let the results of the general inspection dictate if you want to do some other ones. Now, if it's on a hillside, we also will recommend right off the bat starting with a geological inspection, just because in a torrential downpour or a bad earthquake, you really want to know that that house is secure, that that house isn't going anywhere, and the geologist is going to be able to talk to you about the hill, the soil, all that good stuff. Okay, now if it's a condo, you're probably going to be good with just a general inspection, because with a condo, you're only purchasing the space within the walls of your unit. So stuff like the roof, sewer, foundation, that's going to be part of the HOA, the Homeowners Association. So that's where you're probably good to just start off with a general inspector and then see if you need any subsequent ones, like maybe an HVAC person to look at the AC unit, an electrician, whatever it may be. And the point of these inspections is that you're going to be racking up all the issues that the property has, and you're going to be putting a price tag on these properties, because there is a renegotiation moment in the middle of the escrow. It's called the request for repair, and that's where you're going to say, hey, all these problems exist, they cost X amount, and we're going to start negotiating with the seller. And the seller is probably going to be more inclined to offer you repair credits rather than do the work themselves just for liability reasons. And so we're really going to be hoping that we can reach terms with the seller on that number. A lot of deals do fall apart here, but hopefully we're able to reach that negotiation agreement, and then we can move forward with the rest of the transaction. So once we've moved past the inspection contingency, we have the appraisal. And what the appraisal is if you have a financed offer, meaning that you're using a loan, the bank is going to want to make sure that purchase price is in line with market value. Because if you as the buyer, if you default on your loan, the bank is going to foreclose on you, and then it becomes the bank's property. And if you overpay for it, and so their loan amount is higher than it should be, then they're in big trouble. So that's why appraisal is a necessary part of the escrow process. We really are going to hope that the appraiser agrees with us that our purchase price is in line with market value. If they bring the value in under our purchase price, just know that there are a lot of different options there. I don't want to go down the rabbit hole. That's like a whole other 30-minute conversation. But there are different strategies and some different maneuvering that can be done there to still keep the deal together and move on in the escrow. So now that we've moved past the appraisal, the last contingency that we have to worry about is the loan contingency. And this is something that we generally don't have too many issues with, as long as you, the buyer, don't commit any big no-nos. Now, what are these no-nos? Do not go out and buy a new car. That's going to change your debt-to-income ratio, and that could totally disqualify you for the loan. So wait until any big purchases, whether it's a big trip, a new car, whatever it may be, wait until after the deal closes before you do anything that changes your credit, your down payment funds. Just don't mess with that stuff during the deal. You also do not want to change jobs, even if your new job is going to be paying you more. The reason there is that the lender won't be able to qualify your new income until you have at least 2 pay stubs at your new job. So you definitely want to delay that new job until you close. And the lender actually does verify your employment right at the 11th hour of the escrow. So please actually wait until once escrow has closed. So if you abide by those and you just in general keep your finances the same as they were when you were pre-approved, you're probably going to be good on the loan contingency, and the lender is eventually going to get to a point where you are fully approved for your loan. And once that happens, we shift into the closing process, where you're going to sign loan docs one day, and you're going to be sending your remaining funds for the down payment and closing costs probably around the same day that you're signing loan docs. And then the next day, your loan funds, that's where the lender sends their chunk of the purchase to the escrow company. And then the next day, the property records, meaning that you are now the homeowner. Title officially transfers over to you. This is where you get the keys, we pop some champagne, and we celebrate your new entrance into the world of homeownership. Congratulations. We cannot wait to see you at the finish line there. And if you have any questions about anything that we just described here, please reach out. We love one-on-one consultations. We love educating first-time homebuyers about this journey, and we cannot wait to go along on this ride with you.